Palantir stock fell 14% today after there was an announcement that the CEO would be selling $1.2 billion of his own shares in Palantir stock. Then things got worse when there was a report from the Washington Post that the Pentagon will be forced to implement spending cuts. And of course, Palantir gets a great percentage of its revenue from government contracts. So all of that sent share prices down 14% on the back of that news. But investors are now curious, is this a buying opportunity? Right? Palantir stock has been soaring and investors have rarely had an opportunity to buy on a dip here. So is this that opportunity? Should investors buy on this dip? I'll answer that question in this video after discussing the news and what it could mean for Palantir stock investors. Let's get into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Palantir stock, this is today's price action in Palantir stock. It's down 13.9%. It's down a little bit more in the aftermarket hours following trading action on the day. Now, like I highlighted, the company's government business is very important. The U.S. government business is very important. And you compare it to its U.S. commercial revenue, which was $214 million. Government revenue was $343 million. That was up 45%. But more than just the revenue it generates, Palantir's contracts with the government have been a strong signal to businesses to employ Palantir services, because businesses look at that U.S. government revenue and they say, well, if the U.S. government trusts Palantir with these important defense contracts, then we should consider Palantir also. And so if the government business declines because of budget cuts in the Pentagon, that could be one less source of signaling for Palantir, although I don't think Palantir needs it anymore. I think Palantir has grown to a sufficient scale where it doesn't need that signal anymore, where Palantir can go into enterprises now, demonstrate their capability, and secure sales in that fashion. And so the government business, while maybe 5 years ago it was a critically important part of its overall strategy, today it's not as critical. And you can see already the commercial business is growing faster than the government business. And overall, there's more opportunity in enterprises than there is in governments. There's only so much you can get with governments because there's a limited amount of governments, a limited amount of government institutions, whereas enterprises is a multi-trillion-dollar opportunity for Palantir in the long run. So there's a bit of give and take here. The news is not good news in terms of the potential budget cuts in the Pentagon. It's not good news for Palantir, but it's not as devastating as it would have been, let's say, 5 years ago, because of how successful they've been in developing that commercial revenue business. Okay, the next thing I wanted to talk about is the CEO share sale. So Palantir CEO is going to plan on selling $1.2 billion of company stock. And that's never a good sign, but sometimes it's not a very bad sign. Sometimes what I like to say is if an owner has so much of his or her wealth inside of the business, that creates a sort of risk aversion attitude from the owner sometimes. Let's say you're an owner of that business and your entire family's wealth, let's say you're worth $10 billion, but it's all in the company stock, like all of your wealth is in the company stock, then you might become a little risk averse, right? You don't want to make any decisions that could cost your family's wealth by the billions and multi-billions of dollars. And so diversifying away from some of your shares is, not such a bad thing as it seems, right? The optics are terrible. The optics are terrible because just a few weeks ago, Palantir CEO was going on about how successful their company is, how they're delivering things that other companies can only dream about delivering, and how valuable and successful the business is going to be in the long run. And after saying all of those things, you go out and you make this $1.2 billion sale of the shares. It almost seems like if you're an observer and you don't think about it too deeply, it almost seems like the CEO is pumping up the stock to get the price to go up and then selling it to take advantage of that higher share price. That's what it seems like from the outside looking in. But if you think a little more deeply about it, these are things that the CEOs need to do, right? I've talked similarly about when Nvidia's CEO did a similar share plan, uh, sell share plan sale, getting rid of some of the shares so that all of his family's wealth is not tied into one business and locked into that one business. And so I don't mind these. I know there's another side of the investor community that says, no, I want my CEO to be all in and everything to be relying on this business. I want them to live or die by the results of this business. And I can understand that argument, but there's also the other side of the argument where you want the CEO of the business making effective decisions. You don't want them to be risk averse in their decision making because there's billions and tens of billions of dollars of their own personal wealth riding on the line. And so I'm okay with these decisions to sell the stock. But at the same time, I would prefer if the CEOs would not be hyping up their share prices. I'm not a big fan of that. I understand that's one of the CEO's jobs is just to go around and hyping up the share price and talking about how valuable they think their company is and how their company stock is going to go up and they're going to be supremely successful. I'm not a big fan of that, but I understand they need to do those decisions. I'd rather have the CEO just come out and share with me the results that the company is achieving and leave it at that. Don't tell me that you think the share price is going to go up to the trillions of dollars like some CEOs do. I don't need that. I could do without it. Just tell me how your business is performing and let me make the judgments about where the stock is going to go in the future, whether or not I want to own this business. So now speaking about valuation, Palantir stock is supremely expensive. Even after this drop, it's trading at a forward price to earnings of 162. That's very, very expensive. It's a great business to be sure, but it's trading at a price, in my opinion, well above the intrinsic value of the business. It's trading at a level that already incorporates nearly all of its positive prospects for the next 5 years. And so even after the drop, the stock is trading at a forward price to earnings of 162. So I wouldn't see this as a buying opportunity. If the forward price to earnings ratio were to fall very significantly, then I would consider that a buying opportunity. And the forward price to earnings ratio doesn't need to fall because the market price falls, right? There's two sides of this. There's the numerator and the denominator. The numerator is the market price. The denominator is the earnings per share. So the forward price to earnings could fall because the company's earnings prospects improve. And so if I see that and I see its earnings prospects improve and that lowers the forward price to earnings, that could be a buying opportunity as well. So as an investor that's on the sidelines, that's waiting for an opportunity to buy Palantir stock, that's another thing that you can look for is improvements in the earnings per share prospects for the long term, not just market price decreases. What you saw in this video or what you saw in this news is two things. You saw the market price drop considerably, but the news that the Pentagon could be decreasing their budget is news that will lower Palantir's earnings per share prospects in the long run. The probabilities of their earnings per share growth just decreased because of that news, if indeed the Pentagon does decrease those budgets. So you saw a decrease in the numerator, but you're also seeing a decrease in the denominator, in the earnings per share expectations for the next year and 5 years. So you got a bit of both in this development. So in summary, unfortunate news for Palantir stock investors, but that's okay because you've had such a great run. This stock has just performed so well in the last year. So you've probably made great returns on this investment. And so a 10% drop should be not too big, even though it doesn't feel good. A 10% drop is not such a big thing if you've already gained so much in the last year with this stock. But I wouldn't see this as a buying opportunity. I would keep waiting for a better entry with Palantir stock. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've created a book, I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.